Hi everyone, welcome back to the Home Venture. Today we are going to talk about something really important, the Bank of Canada's recent rate cut and how is it going to impact our economy, especially with the ongoing trade war.
We want to make sure we continue building on that relationship. We feel that the temperature is being lowered. That's what we feel, the temperature is being lowered.
So you might have heard that the Bank of Canada on March 12, 2025 lowers its interest rate by another 25 bips. But what does that mean? Is it connected to the trade war? First, let's talk about the role of central bank. Their main job is to keep our economy stable and growing. They also work to control inflation. But if inflation is low and the economy is weak, they might focus more on helping the economy grow in the short term. Now, as we all know that the Trump's tariff has been causing problems for Canadian business. It's making things unpredictable. Companies are facing higher costs, which means they might cut back investment, slow down hiring, and even lay off workers. And consumers, they may spend less because of higher prices. So what's the Bank of Canada doing? They are cutting interest rates to try and boost the economy. By making borrowing cheaper, they are hoping to encourage both companies and consumers to spend more in order to get the economy moving again. And if things get more unpredictable, we might see more rate cuts. But here's the thing, what happens if the Bank of Canada keeps cutting interest rate? Is it a good thing to keep cutting interest rates? Well, not exactly. There's a few potential downsides. For people who have a variable mortgage rate, probably you guys are very happy on the interest savings. And probably you guys are expecting for more rate cuts in the future. However, it can make the Canadian assets less attractive to foreign investors, which could lead to money flowing out of the country. Secondly, lower interest rate can create housing bubbles. Lower rates can drive up the demand for houses, leading to more buyers to compete for homes. These can encourage excessive borrowing and speculative buying, which will potentially create a housing bubble. For Canadians who are already carrying a lot of debts, especially mortgages, continued rate cut may encourage more borrowing, making the debt burden even heavier. If rates go up later, these households are gonna struggle on repaying the loans, increase the default risk. So, while cutting rates can help with the economy in the short term, if it's done too much or for too long, it might cause some long-term problems. Remember to consider your own risk tolerance level before making a financial decision under such a market circumstances. Keep in mind that inflation could pick up in the near future and might cause the Bank of Canada to increase the rates to fight it. So under these unpredictable times, it's always a good idea to increase your emergency funds. So that's all for today. If you find this useful, please don't forget to like and subscribe. I'll see you next time.